Hi, students. Now let me proceed with the preparation of consolidated financial statements, particularly consolidated balance sheet. Okay. Now let me proceed with the Excel sheet. So can you see the Excel sheet now? Preparation of consolidated statement of financial position. To prepare the consolidated statement of financial position, there are certain basic rules are there. Let me understand these basic rules here. So what is given here? Principles of consolidated financial position. The first basic principle is consolidate all assets and liabilities of parent and subsidiary together line by line. The second one is exclude intra-group transactions that took place between parent and subsidiary. Then what is the method of consolidating? Investment by parent in subsidiary is replaced by net assets of the subsidiary. That means the investment in subsidiary by parent is effectively cancelled with the ordinary share capital and reserves of the subsidiary on date of acquisition. So in the process of consolidation, what you have to do? You should not reflect the investment by parent in subsidiary. The investment will not be reflected. At the same time, what you're going to eliminate? The share capital of the subsidiary and the retained earnings of the subsidiary up to the date of acquisition, that will automatically get cancelled. That means investment you are not showing on one hand, and on the other hand, the share capital of the subsidiary and the retained earnings of the subsidiary on date of acquisition. So in simple way, the net assets of the whole group, parent and subsidiary, you are showing, and the share capital of the parent only you are showing in the consolidated financial statements. And the retained profit comprising profits made by the group, which includes P's historical profit, that is parent's historical profit, plus parent's share of the subsidiaries post-acquisition profits, you are going to show in the consolidated statement of financial position. So when you are preparing consolidated statement of financial position, line by line of each asset and asset of the parent and subsidiary, you are going to add line by line the non-current assets, line by line current assets you are going to show. But in that process, the investment made by parent in subsidiary, you should not show. You should not show. At the same time, line by line of the liabilities, of the current liabilities and non-current liabilities you add. But when it comes to the share capital, parent share capital only will be reflected in the consolidated financial statement, not the subsidiary share capital. And parent reserves will reflect in the consolidated financial statement, and subsidiaries post-acquisition reserves only will be reflected. Then automatically your consolidated balance sheet will agree. And in the process, it says very clearly, do not include any of the intra-group transactions that took place between parent and subsidiary. Okay, now let me take small example to make you to understand the consolidation. The small example. Okay, now look into the simple information that is provided here. The statement of financial position of P and parent and subsidiary at 31st December 2004 X4 is given to you. Non-current assets of the parent is 60, non-current assets of the subsidiary is 50, investment by P in S 50, current assets parent is 40, subsidiary is 40. The total assets are 150 for the parent, 90 for the subsidiary. Ordinary share capital of the parent is 100, ordinary share capital of subsidiary is 40. Retained earnings 30 for the parent, 10 for the subsidiary. Current liabilities, parent is 20, subsidiary is 40. So total assets includes total liabilities. Then here it is stated P, that is parent, acquired all the shares in S. When all the shares in subsidiary is acquired, then in that case, the subsidiary is called as wholly owned subsidiary. When the parent invested 100% of the equity stocks of the subsidiary, then in that case, subsidiary becomes what? Wholly owned subsidiary of the parent. Are you clear? So when it is acquired, is acquired on 31st December 2004 at a cost of 50,000. And prepare the consolidated statement of financial position as at 31st December 2004. It is acquired on 31st December 2004 and balance sheet is also given on 31st December 2004. That means acquisition date and the consolidation date is one and the same. So what we said, it is a line by line adding. So when you are adding line by line, non-current assets of the parent is 60 and the subsidy is 50. So 50 plus 60, 110. Then investment, we said very clearly that won't be reflected in the consolidation. So investment by P 50 doesn't appear in the consolidation. Then current assets of the parent 40 and subsidiary 40, total is 80. Are you clear? Then comes to share capital. Share capital of the parent only will be reflected 100. The retained earnings of the parent and the post retained earnings of subsidiary. So there is no post retained earnings. Why? Acquisition date and reporting date is one and the same. So whatever the retained earnings of the subsidiary is there as on date of acquisition will go for calculation of goodwill. Here there is no calculation of goodwill. Why? Because parent invested 50 by acquiring the capital and retained earnings on the date of acquisition. So capital of the subsidiary is 40 and retained earnings on the date of acquisition is 10. Total is 50. The 50 has been invested. So hence there is no goodwill in this case. Okay. So retained earnings of the parent only will appear. There is no post-acquisition retained earnings of the subsidiary. And the current liabilities of the parent is 20 and subsidiary is 40. Total is 60. Now your balance sheet, consolidated balance sheet. How much it is? 190. Very simple way to prepare. So this particular balance sheet, consolidated balance sheet, is a simple preparation of combining line by line of the assets of the parent with a subsidiary, line by line liabilities of the parent with a subsidiary. So in that process, exclude the investment by parent, exclude the share capital of the subsidiary, and exclude the retained earnings of the subsidiary as on date of acquisition. Hope you are clear. This is very simple consolidation. In any group accounting, there are certain steps that need to be followed. There is a standard mechanism, there is a standard working mechanism to prepare the consolidated statement of financial position. So, okay, what are the basic steps that you need to follow? There are 5 basic steps that need to be followed. Okay, so there are 5 basic steps to prepare consolidated statement of financial position. Okay, what is number 1? Identifying the group structure. Identifying the group structure. What does it mean? How much percentage of shares parent is held in the subsidiary? So it is calculation of percentage of shares held by parent in subsidiary. Percentage of shares held by parent in subsidiary. Because to become a subsidiary, parent should hold more than 50% of the common stock or equity stock, ordinary shares of the subsidiary. So sometimes it will be given very clearly in the question. Okay. Sometimes it will be given in the question. Or sometimes it need to be calculated. How it will be calculated? Percentage of shares held by parent in subsidiary is equal to, how we are going to calculate? Number of shares held by parent, number of shares held by parent in subsidiary divided by total number of shares of the subsidiary, total number of shares in the subsidiary multiplied by 100 will give you the percentage. Suppose parent has, okay, let me take some example. The share capital of a subsidiary consists of, okay, $1 each, $1 each is equal to $10,000. $1 each share is equal to 10,000, $1 lakh. That means number of shares in subsidiary is 1 lakh. Suppose parent acquired 70,000 shares of subsidiary. In that case, how you are going to calculate? 70,000 divided by 1 lakh shares. 70,000 divided by 1 lakh shares multiplied by 100. So that will give you 70%. That will give you 70%. Okay, when the 70% is held, then automatically the other company becomes, if the parent invests 70% in other company automatically becomes subsidiary. This is the first step. First step is what? Calculating the percentage of investment, percentage of shares held by parent in subsidiary. That is first step. Second step is what? Is calculation of net assets. Calculation of net assets of subsidiary on date of acquisition and on date of reporting. Okay. So you have to prepare small statement. Net assets you have to calculate. How you are going to calculate? Particulars. Then on date of acquisition. On date of acquisition. So net assets. So if you want to write, you can write net assets. NA. Net assets on date of acquisition. Then say net assets on date of reporting. Then there you can find out difference also, because difference will give you the post acquisition results of the subsidiary. Suppose let me take small example. So what we are going to take in the calculation process, the share capital of the subsidiary. Share capital of a subsidiary. Suppose share capital of subsidiary, suppose say, okay, $1 lakh. On the reporting also $1 lakh. Then there is no difference. Difference is 0. So normal items that will appear in the calculation of net assets are as follows. Share capital 1. Number 2 is called as any premium on shares, or otherwise share premium. Suppose share premium is 50,000. Also no change unless otherwise this number of shares have been issued in the current year. 0. Okay, that is not examinable in this case. Then retained earnings. Retained earnings. Okay, on the date of acquisition, how much it is there? On the date of reporting, how much it is there? Suppose on the date of acquisition is 30,000. On the rate of reporting, it is 50,000. That means that indicates very clearly subsidiary has made profit after the date of acquisition 20,000. That means on the date of acquisition, it is 30,000 reserves of the subsidiary or retained earnings of the subsidiary. On the reporting date, it is 50,000. That means post acquisition period, subsidiary has made a profit of 20,000. Okay, this is what basic information. Apart from this, you are going to show some sort of fair value adjustments. Fair value adjustments. Fair value adjustments of subsidiaries assets. Fair value increase, fair value decrease. Apart from that, this will look into fair value adjustments later on. What are the basic steps? Let me do. Then what else will come here? Any intercompany transaction, particularly intercompany sale of inventory. So whenever there is intercompany sale of inventory, there can be unrealized profit on the unsold inventory lying with the purchaser. So it is called as unrealized profit. Unrealized profit on unsold goods. So that only in this case where subsidiary sold goods to parent, that will come in the reporting location, reporting column, otherwise we can say, okay, unrealized profit on the unsold goods where the subsidiary sold goods to parent. So maybe we'll take, okay, 100. Okay, this is minus figure, you have to reduce. Okay, now you total it. When you total it, what will be the figure? So when you total it, it is coming to, on the date of reporting is 1,80,000. On the date of on the date of acquisition it is 1,80,000. On the date of reporting is what is called as 1,99,900. Understand? Then this also come in the minus 100. So difference how much it is? Post acquisition reserves how much it is? 19,900. So this 19,900 will go to the what is called as the calculation of group retained earnings. Okay, this is a simple way to explain the net assets on the date of acquisition and on the date of reporting. Now, what is the third step? The third step is calculation of goodwill. Okay, what is goodwill? Goodwill is nothing but value of amount paid in excess of the net assets acquired. Or suppose the parent has made investment of what is called as 100,000, but the net assets they acquired only 80,000. The X amount paid or the net assets acquired is called as goodwill. How it is will be calculated? So calculation of goodwill will have two methods. One is called as where you are using proportional method, where you are using fair value method. Where proportional method, where fair value method, what it may be. So in the case of proportional method, it is simple way to calculate. So here what you are going to take? The investment made by parent in subsidiary, parent investment in subsidiary, you take it. Whatever the amount you take it. Suppose parent investment subsidiary, suppose say, okay, 2 lakhs. Suppose say 2 lakhs. Then minus less parent share of net assets of subsidiary on date of acquisition. Okay, so what are you going to do? Less parent share of net assets of the subsidiary. That's what? Parent share of net assets of subsidiary on date of acquisition. ACQ. So what is parent share? Suppose in the above example, parent is holding suppose 70%. 70% of net assets of the subsidiary, how much it is? 1,80,000. Okay, so that figure you're going to take while calculating the 70% of 1,80,000. So 70% of 1,80,000 is equal to 1,80,000 multiplied by 0.70 is coming to 1,26,000. So you remove 1,26,000. Then so parent made investment 2 lakhs, but the net assets they are acquiring from subsidiaries 1,26,000. Hence, goodwill is coming to 74,000. This is what is called as goodwill. This goodwill will be shown in the consolidated statement of financial position. So this goodwill will be shown in consolidated statement of financial position. What does it indicate? The parent made investment of 2 lakhs in subsidiary, whereas the net assets parent acquired only value 1,26,000. Then the remaining amount excess, whatever that is paid, is attributed to goodwill. Okay, very simple to calculate. Suppose if it is under fair value method, how you are going to calculate? In such case, whatever the parent investment made in subsidiary, that will appear as it is here also. That means parent investment in subsidiary. How much parent invested? The same 2 lakhs will appear. To this, you are going to add the fair value of the non-controlling interest. Fair value of the non-controlling interest. What is non-controlling interest? Whatever the interest that is held by the parent, remaining interest is called as non-controlling interest, also called as minority interest. The parent is holding 70%, remaining 30% is held by some other investors in subsidiary. Their interest also need to be calculated. So this value can be given in the scenario, or this value can be calculated. Let me assume the value has been given in this scenario. Suppose the value has been given as say 40,000. The value is given as 40,000. In that case, total if you add, it will give you total value of the company, total value of the subsidiary. Okay, how much it is? 2,40,000. From this, what you're going to do? Less net assets subsidiary, net assets of subsidiary on date of acquisition, on date of acquisition. We already calculated net assets of the subsidiary on date of acquisition. How much it is? 1,80,000. This figure we already calculated now. So you have to take the same figure, whether it is what is called as a proportional method or whether it is fair value method. In the case of proportional method, you take only parent share while calculating. If it is a fair value method, you take total amount of minus 1,80,000. Okay, so in that case, goodwill is coming to 60,000. Now, please understand very clearly. Here, the 74,000 goodwill is totally attributed to parent. So here, okay, in the proportional method, otherwise, the total goodwill is attributed to parent only. Now here, the goodwill, okay, in the proportional method, it is attributed to parent. But in the fair value method, in the fair value method, total goodwill is attributed to parent and, okay, non-controlling interest. That is what is called as NCI, non-controlling, simple. So here, whatever the 60,000, this 60,000 will go to this goodwill will be shown in consolidated, okay, balance sheet. Otherwise, whatever you say, statement of financial position or balance sheet is clear to you. That is step number 3. So step number 1 is calculation of group structure. That means how much parent is holding in subsidiary, how much other than parent is holding in subsidiary. That is called non-controlling interest. Second step is calculation of net assets on the date of acquisition, on the date of reporting. Then the third one is calculation of goodwill. Okay, there are two methods are there for calculation of goodwill, where proportional method is being used or where fair value method is used. Okay, in the case of proportional method, we shown very clearly how to calculate. In the case of fair value method, we have shown very clearly how to calculate. Now, the fourth step is called as calculation of non-controlling interest. Calculation of value of non-controlling interest. So, NCI. Okay, how you are going to calculate? Again, for this also, you have two methods, where proportional method is being used, where fair value method is being used. Okay, how you are going to calculate under both methods, let me look into. Under the proportional method, you take whatever the NCA share on the net assets on the date of acquisition. So NCA share of net assets of subsidiary on date of acquisition, you calculate. Okay. Okay, so how you calculate? NCA share multiplied by NCA percentage multiplied by net assets of subsidiary on acquisition. Okay, now if you see the example, NCA share is how much it is? 30% in the above example. 30% of net assets on the date of acquisition, how much it is? 1,80,000. That will come here. 30% of 1,80,000 will be shown here. Will be shown here. So that is equal to how much it will be? It is equal to, okay, 1,80,000 multiplied by 0.30. To this value of 54,000, you have to add post-acquisition reserves of the subsidiary. So add NCA share of subsidiary post-acquisition reserves. Okay, then see how much it is? 30% of post-acquisition reserves we already calculated here. So we have shown very clearly what is the post-acquisition reserves. 19,900 is the post-acquisition reserves. So you take that figure, 30% of 19,900. Okay, that is equal to 0.30 multiplied by 19,900. So 5,970. This is the total figure is the, okay, but there can be some more adjustments that can appear. There can be, okay, add or less adjustments, add or less some adjustments. What are the adjustments? We'll see later. This figure, how much is coming to without any adjustment? This figure is coming to how much it is? Okay, 59,900. The same figure you can calculate alternatively also. How to calculate alternatively? It is simply NCA percentage multiplied by or, you can calculate alternatively, or NCA percentage multiplied by net assets of subsidiary on reporting. So NCA percentage, how much it is? 30% multiplied by net assets of the subsidiary on reporting. We already calculated here. Net assets of subsidiary on reporting, how much it is? 1,99,900. You take that figure, 1,99,900. 1 lakh, okay, 99,900. So you take how much is coming to is equal to 0.30 multiplied by 1,99,900. You get the same figure. You will get the same figure. There is no difference. Either you can do like that or you can do like this. Whatever it may be, it is one and the same. Are you clear? This alternate way of doing the calculation. Okay. Now, when it comes to the fair value method, how you are going to calculate the NSA value? Here, they will be providing. So, either you have to take first what? The fair value of the NCI. The fair value of NCI will be provided in the question, or otherwise it can be calculated. If provided, you take what of the figure provided. If the figure is provided, take the figure given, or alternatively how to calculate? Simply NCA, okay, NCA number of shares, NCA number of shares in subsidiary multiplied by NCA number of shares in subsidiary multiplied by fair market value of subsidiary share on date of acquisition. Suppose fair value of NCA is given, suppose as 50,000, or let me say 60,000. And we say very clearly NCA is holding 30% of 1 lakh shares. 30% of 1 lakh shares is equal to 30,000. 30,000 shares held by, okay, NCI. And if the market price of subsidiary share is $2, then the fair value of NCI is 30,000 multiplied by $2 per share is equal to same 60,000. They will provide either the value of the fair value of NCI, or they can give you the basis. What is the basis? You have to take the number of shares NCI is holding in subsidiary. Number of shares NCI is holding subsidiary. How to calculate? So in other words, you can calculate number of NCI percentage multiplied by number of shares of subsidiary multiplied by market price of the subsidiary share. Market price of subsidiary share. That means NCI percentage, how much it is? 30% multiplied by number of shares of the subsidiaries 1 lakh multiplied by $2. Multiplied by $2. Same thing will give you same 60,000. Are you clear? So whenever you are going to calculate the calculation of NCI value, first you take fair value. So I have given you calculation how you are going to take fair value. So once the fair value is 60,000, to this fair value, what you're supposed to do? Either it is given or you calculate, whatever it may be. Okay. So to this, you have to add NCI share of post-acquisition profits of subsidiary. NCI share, how much it is? 30% of post-acquisition profits, how much it is? 19,900. We already shown above. That is what, please check the figure. Post-acquisition reserves already calculated here. 19,900 is the post-acquisition reserves of the subsidiary. On that NCI share, how much it is? It is 30%. So you have to add. So it's equal to 0.30 multiplied by 19,900. So 5,970. Here also you are adding NCI share of the post-acquisition in the case of proportional method. In the fair value method also you are adding. But in the proportional method, there is no fair value of NCI. You are taking the proportionate value of the net assets of the subsidiary on date of acquisition. To that you are adding post-acquisition reserves of the subsidiary. But in the case of fair value method, you take the fair value method that is given or calculated, then add the NCI share of post-acquisition profits of subsidiary. To this figure, there can be certain adjustments, add or less other adjustments. That adjustments you will understand later on. So for the time being, okay, this is the net assets of the, sorry, this is the fair value of the NCA, otherwise fair value, NCA value, otherwise we can say NCA value. How much NCA value? 65,970. Okay, we calculated the fourth step. So fourth step is what? Calculation of a NCA value. This value, where NCA value will be taken to this. So you have to note, okay, what is the note? NCA value will be taken to the consolidated statement of financial position. NCA value will be taken to consolidated statement of financial position and show below the equities, below the equity, and it is also part of equity. So when you say equity, parent share capital plus retained earnings of the, okay, group and the NCA value. All these you are going to reflect in the consolidated balance sheet. Okay. So whether you calculate the NCA value using the proportional method or you calculate NCA value using the fair value method, the NCA value will be taken to consolidated statement of financial position, okay, below the equity. After the share capital, after the retained earnings, you are going to show the NCA value. Then you will get total equity. Now that is the fourth step. Now the last step, very important step, is called as a, okay, calculation of group retained earnings. So what is the fifth step? Okay, calculation of group retained earnings. Here there is no any method. Only method is applicable only for calculation of goodwill and for calculation of NCA value. For calculation of group retained earnings, how you calculate group retained earnings? Okay, here parent retained earnings, take 100% of parent retained, 100% of parent retained earnings. 100% of parent retained earnings as per balance sheet given to you. Suppose whatever the figure you take, whatever the figure that is given, you take. Suppose it is given, suppose say 1,20,000, suppose. Okay. Then to this, you're going to add parent share of, okay, post acquisition profits of subsidiary. So parent share, how much it is? 70%. How much parent share? 70% of post acquisition profits of subsidiary. We already calculate how much it is? 19,900 that you are going to take here. So is equal to 0.30 divided by 19,900. So you are going to add. If it's a loss, you have to reduce it. If it's a profit, you have to add it. So this figure you are going to add, because maybe if it is a profit, you are going to add. If it's a loss, you are going to reduce it. It is a parent. Clear? Apart from this, there can be some more adjustments. Add or less, okay, adjustment. That we will understand later on. For the time being, if there are no any adjustments, this will be the total group retained earnings that you can take to the consolidated balance sheet. So this figure you are going to take to the consolidated balance sheet. Okay, so this figure need to be taken to the consolidated statement of financial position. These are the 5 important steps that you need to follow. Once you complete all these following 5 steps, basic balance sheet can be prepared. But sometimes there can be additional information you have to keep in mind. And sometimes, most of the cases, okay, there will be some sort of intercompany balances, intercompany transactions. These are called as adjustments. So that we will see later on. So what you have understood now is a basic consolidation steps. What are the basic consolidation steps? Once again, number 1 is called as a group structure. Okay, it will give you the parent percentage in subsidiary and other, okay, others holding in subsidiary. Parent percentage subsidiary and other holding subsidiary. Number 2 is called as net assets of a subsidiary on date of acquisition and on date of reporting. Number 3, calculation of goodwill. Okay, either you can use proportional method or use fair value method based on the information. Then 4, calculation of NCI, non-controlling interest otherwise. So this also you can use proportional method or fair value method. And 5th one is okay, calculation of group retained earnings. These are the 5 important steps that need to follow. Okay, once you follow, then basic consolidation will be over. Then beyond basic consolidation, what are there? Because of intercompany transaction, these adjustments are basically relating to intercompany transactions that we will see later on. And what are the other rules we'll see in the next session. Okay, so basic consolidation is very simple. Basic consolidation is very simple. Now, consolidation can take place after the acquisition. Consolidation can take place on the date of acquisition. After the date of acquisition is slightly a little bit complicated, but on the date of acquisition, on the date of consolidation is very simple. Are you clear? Okay, so we'll close here. We will see next time with one example with consolidation, with basic consolidation, because basic consolidation is strong. Then adjustments, if you understand the adjustment, then it will be consolidation becomes easy. Okay, so my name is okay Gutti R.K. Prasad. You know very well. Okay, my contact number 9542978515. My email is Gutti 1959 at Gmail. So if anybody needs any help, please contact me. So I will explain you the next what is called as the session, next what is called as series. Maybe tomorrow I will add with a clear cut problem with steps. You will understand. Okay. Anybody is having any clarification, please call me 9542 9542 978515. Okay. Thank you very much for seeing the video. So if you share with anyone, please share it. Please subscribe, so that will encourage me to prepare more and more videos that may help you to prepare yourself. These particular concepts are basically helpful for those preparing for HCA December exam. I'll give you very clearly the full way how you can prepare exam question, how you can easily what's called as a break through your exam questions. Okay, I'll explain you. Don't worry. Okay, thank you very much for watching.